Welcome to the WTR Small-Cap Spotlight podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. In today's podcast episode, I'm being joined by Mihir Dange, Chief Executive Officer of XCF Global, NASDAQ, ticker symbol SAFX. XCF Global is the first publicly traded pure-play sustainable aviation fuel, or SAF, producer in the United States. The company's new Rise Reno facility began production in February 2025, and the company is advancing a pipeline of projects for planned startup in 2027 and 2028. Also joining us is Simon Oxley, CFO of XCF. Lastly, joining us is my WTR equity research colleague, Peter Gastreich. Good morning, gentlemen, and thank you for joining today's podcast.
Good morning, Tim and Peter. Thank you for having us. We really appreciate it and looking to speak to the Water Tower research community.
Great. First off, Mihir, a big congratulations on the company's NASDAQ listing this past week. That's a huge milestone. And for those listeners who may not be familiar with XCF Global, can you please provide an overview of the company and its corporate strategy? And also, I always like to ask our guests to provide a quick overview of their professional backgrounds.
Sure. Again, thank you for having us. Just a little bit about myself. I'm Mihir, the CEO of XCF Global. I spent about 15 years on the commodities floor. Then I spent about 5 years putting in government regulation around taxi medallions in New York, and find myself at the cross section of commodities and government regulation. Simon, would you like to?
Oh, thank you. Yes, so Simon Oxley, CFO of XCF. I was formerly CFO of a company called Tellurian that was an LNG developer and was acquired by Woodside last year. And prior to that, I used to co-head the oil and gas investment banking team at Barclays, where I did 22 years of energy-related investment banking. Good to meet you.
Great. And then before we jump into some questions from Peter, maybe Mihir, you just give us a quick overview of the company, kind of a 30,000-foot view, because I know we're going to dig into greater detail with Peter.
Yeah, happy to, and I appreciate that. XCF Global is the first and only pure play sustainable aviation fuel company that is publicly traded today. The idea was to create an investable product around one of the largest growing industries over the next decade, and to be able to do that in a public setting for investors to really participate into this ecosystem. We're really focused on what the future is of SAF, and this liquid is going to be the highest growth liquid we think you'll see over the next decade or two. So XCF has its first facility in Reno, Nevada, which is productional with 40 million gallons of SAF on a run rate basis when it's at full capacity. We just brought production on about 2 or 3 months ago, so we're in the ramp up process. And we have three other facilities that we intend on bringing online over the next 3 years, which would bring total production to about 160 million gallons. So we're really focused. That's just the first part, the core part of our business. We have other things that we are looking at that I'm sure we'll dig into a little bit later.
Excellent. And I agree with your observation about the growth characteristics. As a former sell-side analyst covering specialty chemicals, I've been watching from afar, and it's actually quite exciting. So thanks for that overview, Mihir. And I'm now going to turn the podcast over to Peter to ask a few questions.
Hey, thanks, Tim. Thanks, gentlemen. So maybe before we dive into the company's operations and dig a bit deeper into XCF strategy, maybe this is for Mihir. Could you please provide a high-level overview of the long-term demand outlook for sustainable aviation fuel, or SAF? What is the size of market opportunity here for those who may not be as familiar with the investment theme?
It's a great question because I think we need to understand what the TAM looks like, right? What is the TAM of this market? And we are call it very early on, almost in the first inning of what I would call this ball game. Domestically, the goal is to have 3 billion gallons of SAF produced in 2030. And globally, that's supposed to be about 6 or 7 billion gallons around the world by 2030. It is anticipated that we will have a global shortage of about 2 billion gallons over that 5-year period. That then escalates all the way up to 2050, where the goal is to have 70% carbon reduction, or call it less pollution. And the anticipation is that that will require somewhere between 20 and 25 billion gallons at minimum, and we're already going to see a shortfall in the next 5 years. So we think that the global demand around SAF is going to be really important. And in particular, it is the predominant way to decarbonize the aviation industry. While there is focus on advancements of the plane and potentially looking at hydrogen solutions, looking at long range batteries, we're still not there. Long and mid-range batteries are still a long ways away because of the ability, because of the weight capacity for these planes. So I think we will find the advancement of the plane, but that is going to be decades from now. And the only immediate way to really address the need in decarbonization and to meet a 70% decarbonization goal is going to be through SAF. And it looks like in the next 5 years, we're already going to be outpacing supply.
Yeah, that's a good point on hydrogen. And, especially if you look as evidence there, about a month ago, Airbus announced that they were delaying their entire kind of hydrogen development plans by at least 10 years. So that's really another kind of, big boost for the SAF outlook there as well, in terms of what else could compete for it. And there's really not much else out there, especially for those long haul flights. But we just want one more backdrop question here. Investors have a lot of options to consider when it comes to investing in renewables, be it sustainable aviation fuel, EV battery chain, solar, wind, and so forth. Against this backdrop and choices that investors have, how would you characterize the attractiveness of pursuing SAF as an investment when compared to other renewables? This can be in terms of policy risk or any other way you might want to frame it.
Simon, do you want to take this one?
Yeah, sure. I think it's a great question. If I pick you up on policy risk, as Mihir mentioned, 85% of the carbon emissions coming from the airline industry is from the fuel. And as we've talked about, there's no alternatives to the airframes for at least the next 20 years. So the only way the policymakers can actually push through any type of carbon reduction in the airline industry is through fuel. And as such, what we have seen is, despite there being a lot of noise in different markets and different jurisdictions around fossil versus renewable, we have seen a consistent march forwards by the airlines themselves, be that on a voluntary basis or on a mandated basis, in order to meeting their targets set for 2030, 2035, 2050, depending on the airline. With regards to the implementation of those policies, from a regulator perspective, it's easier for them to implement these policies, frankly, than any other policies we see across the market, because there's a relatively small number of parties who are providing the fueling services to the airlines. There's a concentration of airlines, and therefore their ability to actually implement these policies in a relatively frictionless fashion is far higher versus other areas of the market. So we don't see any substitution risk. We do see regulatory adherence in relation to these policies, be that regulatory mandated or be that on a voluntary basis. And also we're seeing there's no abatement in relation to the demand for the airline industry usage. So we're seeing a growth in airline flights and short and long haul flights. So we're pretty confident that there's really no substitution risk associated with this, and that the regulatory mandates around this are staying robust. And also from a US perspective, the US has been very supportive for producers in this space. And therefore, we feel we're optimally located to have production in the US, but having the option or the ability to grow internationally and to support the SAF manufacturing and supply chain elsewhere.
Yeah,
okay,
and
thank you, Simon.
Sorry, if I can add to that also, I think it's an interesting question that you raise around renewables and the renewable sector. I think in the previous administration, there was a lot of push for ESG type of products. And now we're seeing in a new administration a real push towards petroleum-based products. But I think if you look at the called the 10-year trend, the next decade trend, in decarb of aviation, we know that year-on-year growth for airlines is going to continue. We know that the need for the molecule, the SAF molecule, is only going to continue to grow, and we can dig into that around mandates and whatnot. But I think that a decade from now, we're fighting two different battlegrounds. We're going to be looking at very skilled, specialized type of labor, and we're going to be looking at infrastructure and energy, because those are going to be the battlegrounds where the skilled, specialized labor is the antithesis of AI, and the infrastructure and the push towards energy is going to be the support of AI. So you're going to find a little bit more of a barbell effect, I think, which should really play well when you take the backdrop of all the other things that are happening.
Okay, great. Thank you very much. So we have SAF, growing into large market opportunity, in the interest of the U.S., as you mentioned as well. Maybe so with that, let's turn to XCF and discuss how the company is going to capture this opportunity and dig into your operational strategy. It'd be great if you could sort of, touch into that strategy in terms of your growth outlook. Where are you locating your SAF plants and why, and what process or pathways are you choosing to get there?
Yeah, so I think when we look at the XCF operational strategy, we should also just look at the SAF outlook as a whole. And we've already outlined what SAF is going to look like, which is there's a lot of demand. So in order to meet the demand, we're looking at today, I think, call it in the neighborhood of 45 active facilities in the world. In 2050, that analysts have kind of indicated that number should be about 4,500 in order to meet the overall expectations of supply and demand, create supply demand balance at that point. So we're expecting 100x growth in infrastructure itself. To me, our operational strategy is, do we have technology that works? Check. Yes. We have a plant that's up and running today that has produced SAF. The second part of it is, do we have a pipeline of growth? Yes, we do. We have 3 other projects that are in the works that we plan on bringing on over the next 3 years. That helps to add to the infrastructure. And ultimately, it's going to be 2 things. It's going to be horizontal growth, which allows us to bring volumetric production on, and vertical growth, which are all the things that feed into this ecosystem, all the supply chain needs, everything from logistics to pretreatment to feedstocks that can help supply all of these facilities. So operationally, I think Simon loves to use this expression, crawl, walk, run. So we're in the crawling to walking stage, which is we have a facility that's up and running. It can produce the molecule. That has been half the challenge right there. Then we opt to optimize the business and the net backs so that we're a profitable business. That's also been half the challenge with a lot of these companies. And then to be able to replicate that with some type of precision would be the next step beyond, or call it the next concentric circle. And then the concentric circle beyond that is, what are all the things that supply all the supply chain portion of it. Now, that's where I think it's interesting that we went public, because the idea of having a public entity is it gives us visibility around the growth, but it also gives us a currency which we may be able to use to help expand. And I kind of mentioned previous that the renewable sector has had its ups and downs with the administration. So investors who have been in projects for a long period of time and are looking to get cycled out now have a public vehicle in which they can do so.
Okay, got it. Thank you. And what about in terms of the expansion? Because I understand you'll have some additional plants coming or planned in the next few years.
Yeah, that's the intention. So we have Reno Facility 2. That would be our most immediate project. That would leverage a lot of the existing infrastructure. It reduces build cost by about 33%, build time also by 33%. And and again, we get to leverage some of the infrastructure that's there already and permitting and whatnot. So that's a huge next step for us. It would double our capacity from 40 million gallons to 80 million gallons. And then the intention is to bring on two other facilities. We have one in North Carolina and one in Florida, which are strategically located to service the East Coast, which we notice is an underserved part of the market today, and bring those volumes on over the next, call it 3 years or so.
Okay, got it. So, feedstock sourcing and offtake agreements are really something that are just so critical for SAF operators. I understand you have a quite unique relationship with Phillips 66. I'd like to dig a bit more into that and sort of discuss how that differentiates you and enables, a more stable source of feedstock. And moreover, how should we think about how these agreements with Phillips 66 in terms of feedstock and offtake, how do those, translate into, reasonable margins and returns? Maybe this is one for Simon.
Yeah, sure. So firstly, as a business at our stage, it's incredibly helpful to have Phillips 66 sitting behind us because they have 800 traders globally. They have a very substantial supply and logistics network. And therefore, the ability to always know that we can secure feedstock whenever we need it and always know that our product can be lifted and supplied into a relevant market is extremely helpful. So we never get stuck in a position where we have stranded product, be that feedstock or produced product. The ability to leverage off that platform is twofold, because firstly, they provide a very useful backstop, but we also have an arrangement whereby if we're able to achieve preferential pricing to that of what P66 is able to achieve, then we can sell into third parties, and there's a profit sharing arrangement in place with P66. So with regards to our ability to optimize netbacks, it works very well because we always have effectively this backstop position through the Phillips network. And then, as Mihir's already mentioned, we are actively looking at optimizing our netbacks to ensure that we get the best possible margin. And as we think through both the organic and inorganic opportunities, we look through it through that lens as well to how can we enhance or improve the netbacks. Because again, coming back to your previous question as to what's the relevance of SAF, SAF is an operating profit margin business. Unlike a lot of renewable businesses that have been discussed previously, we are looking at making money and providing SAF to the market. So we're able to decarbonize the market, but also do it in a profitable fashion. And therefore, we believe the combination of the backstop support and netback optimization sort of positions us extremely well to be able to get the best possible outcome in relation to our product.
Okay, thanks. Maybe we could talk a bit more about, while we're on the margins, maybe we can talk a little bit about where those, margins are kind of standing today. I think if we look at some of the renewable fuel producers, for example, Neste, they've been operating SAF projects, renewable diesel for a number of years. They had a number of really good years, and then into the end of last year, beginning of this year, quite a few renewable fuels operators have had some negative impact on their margins. I would be kind of curious your thoughts about the state of the industry today, and what are your thoughts about the prospects of recovering from where we are now into the coming years, and what will be the impact on your existing facility that's in operation since February?
That's a great question. A lot to unpack there, and obviously, I think people are always focused on profitability. The renewable fuels sector has definitely been weaker over, call it, the last 6 months or so with a new administration. I alluded to this prior, but in a previous administration where there was a lot of focus around ESG, we noticed that there were a lot of dollars being moved into ESG at that time. Now there's a focus towards petroleum-based products. I think there are a lot of interesting things that are happening, call it one after another. ESG investment has kind of has is definitely less formidable than what it was before. I don't want to say it's drying up. Um, the margins on the green premium, as they call it in this space, what used to be, call it Jet A plus $2 or $2.50, have definitely skinnied down pretty dramatically. And RIN pricing, which was a support mechanism, saw its lows earlier this year. So I think it sounds pretty dismal, but it makes me really excited because it's such a fantastic opportunity to bring a company public, to be in the space and to build, right? To build when margins are skinny is a great opportunity to build horizontally, to cycle out investors, to create M&A opportunities, and create really what is a SAF platform that is meant to be out there that maybe we wouldn't have that opportunity prior to. I think the market, especially outside of the Americas, is deeply interested around SAF. There are countries that have mandates. They're pushing, call it, what is a 2% molecule that has to go into the wing that will be 20% in 10 years and 70% in 25 years. And we're seeing country after country repeatedly come in and say, okay, we're now going to mandate the usage of this molecule. It's only in America where we're seeing it a little bit different, where it's voluntarily based. But now, 6 months later, we're seeing the support come from the administration. They've put in support around 45Z, which is now going to remain till 2031. There is support for domestic feedstocks. There is support in maintaining the RIN program. So I think now we're seeing the biofuels portion is a carve out, and in an attempt to make America great again, it's to support the farmers in America. So internationally, there's obviously a tremendous focus. Now, domestically, we're starting to get the policy support. I like that this is almost like a tiny little gem that will stay here. This niche will stay here for some period of time until it doesn't. And that's an opportunity for us to really take advantage of while the space is still developing.
I would probably add to that as well that we have to remember that the EU refuel mandate only starts on the 1st of January of this year. And as we're starting to see other countries turn on the mandates, so for example, Europe is receiving quite a lot of feedstock and product from China. As soon as China turns on their mandate, and they have a more, allegedly a more aggressive mandate than we're seeing from the EU perspective, you're going to see all of that product remain in China, and possibly and then some. And therefore, we are right at that cusp of moving through the different stages, as we mentioned, 2% this year, moving up to 6% or 10%, depending on the market. And therefore, I think that the relative oversupply can swing back almost immediately as soon as some of these larger economies turn on their mandates. So my prediction would be if China turns on their mandate the latter part of this year, then you'll see a substantial reduction in supply available on a freely traded basis. And we'll see prices snap back to what we've seen historically.
Okay, thank you. So far we have quite a few unique aspects to the story here. The only pure play SAF operator out there. You have an operating project today. You're not waiting to develop something. You are operating today, and you have this unique relationship with Phillips 66 in terms of your feedstock and in terms of your offtake. All these are very unique aspects of the story. And I understand that you do have a unique approach to your financing and capital strategy as well. It'd be great if you could discuss a little bit about what you're doing there.
Yeah, sure. So first of all, we need to take a step back when we talk about the financing strategy, because what we're looking at is modular plants that we can put in different locations and that we can finance on a private capital basis. The relevance for that is that we can put up a plant in just under 3 years for about $350 million. And this gives us the ability to get to a cash producing, diversified production source in relatively short time frame, but it does not overstress the funding market. There are a number of projects that have been slated that are $1 billion plus. A lot of those projects are reliant upon government-related support or government-related loans. And we believe that, whilst it's helpful, we want to see all of these projects do well because we need to see that supply come through. We believe our ability to move quickly and to finance successfully these projects is really a USP of what we represent. Now, over time, as you've heard Mihir say, the crawl, walk, run model is we obviously can look to larger projects as we reinforce our balance sheet and we gain scale. But what we're looking at is a cash-producing, operating profits business and financing it on that basis. Of our existing facility, we benefited from a USDA-backed loan in order to be able to convert the facility and have a SAF production basis as we currently have today. But yes, we're looking at utilizing private credit markets. We're not reliant on government-related sponsored loans going forwards. And we believe the NASDAQ listing provides that sort of capital structuring support that currently doesn't exist in the market because the market is quite early on in regards to financing SAF. It's not like a typical project financing related market, for example, like an LNG, where you have long-term offtake arrangements and strong credit counterparties on a 15-year basis. We're looking at a lot more spot market exposure, but the demand profile for SAF is so robust that we're very confident in the economics associated with that market.
Okay, that's great. Thank you. So now if we're looking ahead, what would be the key signposts at XCF that investors should be focused on over, say, the next 12 to 18 months?
I think we need to look at what the market is not seeing today, right? And what is the market not seeing? The market is not seeing the molecule. The market is not seeing profitability and expansion. So I think if we want to differentiate ourselves, and we want to build a SAF platform. We really are very passionate about creating something very different that investors can hold on to. We have to focus on profitability and getting the molecule and creating an ecosystem that is dedicated to SAF. And I think it's as difficult and as simple as that.
And I would probably add that we're obviously, we have our organic growth platform, the 3 projects that we've talked about, but our ability to accelerate growth and gain critical mass on a far quicker basis also comes from, as Mihir mentioned, the non-natural equity holders that are sitting in this space, sitting in illiquid infrastructure assets that would be more valuable on our platform. And we offer a path to liquidity for those types of businesses. So therefore, our ability to consolidate on an accretive basis for our shareholders is also a very important growth factor for us across the value chain, as we've talked about.
Okay, thank you, Mihir and Simon. This was great. We really appreciate your expertise on the industry, and congratulations to you and your team at XCF on executing your strategy to date. We are running out of time, but before I pass back to Tim, I'd just like to give you the opportunity to provide any concluding remarks or address anything that we might have missed today.
Well, Peter, I really appreciate the very thoughtful questions, and Tim, thank you for hosting the show. I think I would just conclude with this. I think when I think of SAF, it's just such an interesting market. I think the future of it is really bright, where there is going to be undoubtedly the need for it. It's proven in policy, it's proven in the supply-demand imbalance. So there's no question, in my opinion, will there be a need for it? I think the real question is, who is really smart about thinking about what that looks like 5 or 10 years from now, whether it's us or not us, but who is thinking about what the world of SAF is for an investor, for the customer, and potentially for the public. And I think somebody who can envelop that idea, it starts potentially with a kernel of something, but can envelop that idea is going to be really successful. We're trying to do it, but we implore others to come and join because that is really how this industry is going to grow.
Great. Thank you for joining us today, Mihir Dange, CEO, and Simon Oxley, CFO of XCF Global, NASDAQ, ticker symbol SAFX. And again, gents, congratulations on last week's NASDAQ listing. And also thanks to my equity research colleague, Peter Gastreich, for also joining us. And a special thanks to the producer and editor of the podcast, Joe Brunetto. Thank you for listening, and don't forget to subscribe as well as visiting www.watertowerresearch.com to stay up to speed on the company's small cap written research reports, podcasts, fireside chats, and conference schedules. We will see you next time for another edition of the WTR Small Cap Spotlight podcast.